All right, welcome to today's briefing. We're dropping right into the tactical battlefield data you absolutely need for the May 19th opening bell. Look, today we have a really fascinating mystery to unravel. Just a massive amount of conflicting data. Institutional money is flowing heavily in one direction, while technical indicators are flashing bright warning signs in the exact opposite direction. If you're trading today, you need to know exactly where the traps are set and where the safety nets are sitting. So let's dive into this data and figure out what's actually happening beneath the surface.
Let's kick things off with the ultimate conflict we're seeing in the price action right now. On one hand, the indices recouped their initial losses with a pretty solid bullish bounce. The Nifty actually managed to close with a modest gain of 0.03%, forming this bullish candle with a noticeable lower shadow and filling that opening bearish gap. Basically, that tells us buyers are stepping in at lower levels. But beneath the surface, the undertone is highly cautious. The index is still trading below the 10 and 20-day exponential moving averages. Actually, both of those are trending downward right now. And crucially, momentum indicators like the MACD and RSI are flashing sell crossovers. So the bottom line? Price action showed a bounce, sure, but the structural momentum is still heavily weighed down by the bears.
Section 1. Nifty 50, the tactical range. To navigate these mixed signals, let's isolate its critical trading box.
What's truly fascinating here is how clearly defined our playing field is right now. The broader battleground is set right between 23,250 and 23,800 for the short term. Now, if the bulls can push past that upper boundary, 24,000 to 24,100 are the major levels you've got to watch. But pay very, very close attention to that bottom line. 23,400 is the critical pivot. If the market sustains below 23,400, it's like a trapdoor opens directly down to 23,250. And hey, if that breaks, we're looking at a slide all the way down to the 23,100 level.
Okay, here's your exact tactical terrain for the Nifty, broken down by pivot points. If the floor drops out, 23,410 is your absolute first lifeline, and notice how that aligns perfectly with the trapdoor level we just talked about. Below that, 23,320 and 23,176 come into play. On the flip side, if we do get an upward push today, 23,699 acts as your immediate overhead resistance, followed by 23,788, and finally 23,933. Honestly, keep these numbers jotted down. They are literally your map for the day's volatility.
Section 2, Bank Nifty, Critical Battlegrounds. We're seeing a very similar technical setup here, but with its own unique battle lines.
So the Bank Nifty actually closed 0.3% lower, but just like the Nifty, it filled its opening bearish gap and formed a bullish candle with a long lower wick. Notably, it tested the 61.8% Fibonacci retracement of the April rally before bouncing right back. These are your strict pivot points for the banking index. You're going to want to watch the 52,992 support line closely as the bull's first major line of defense. If that breaks, 52,783 is up next. Now, if the financials catch a bid, resistance sits at 53,667 and scales up to 54,214. Just remember, much like the broader market, it's sustaining below key moving averages, so definitely proceed with caution here.
Section 3. Option chain, walls, and nets. Let's see exactly where the massive money is building physical walls and safety nets.
This open interest data brilliantly illustrates the macro boundaries of the market right now. On the Nifty, we're boxed in by a massive resistance wall of 1.26 crore call contracts, setting firmly at 24,000. I mean, that is going to be incredibly tough for the bulls to chew through in the short term. Fighting against that, though, is a really strong safety net of 1.24 crore put contracts down at 23,000. So it basically have a very well-defined 1,000-point macro range where option writers clearly feel comfortable. Over on the Bank Nifty, the story is quite similar. The ceiling is firmly cemented at the 55,000 strike with 8.49 lakh call contracts. Meanwhile, the floor holds incredibly strong at 53,000 with 8.75 lakh put contracts. What's super notable here is that we saw maximum put writing happening right at that 53,000 level. That tells us option sellers are heavily defending that zone as the absolute ultimate line in the sand for the banking sector.
Section 4. Institutional flows and VIX. The rapid-fire data hits. Let's pivot from the charts to the actual cash driving the market today.
Foreign institutional investors are literally loading up the cannons. Despite the bearish technicals we just looked at, they secured 2,814 crore rupees in net buying. That's a massive injection of capital from foreign players who are clearly seeing some real value at these levels.
And get this, domestic institutional investors are stepping up even harder. They pumped in a massive 4,703 crore rupees. Look, when you have both FIIs and DIIs buying aggressively on the exact same day, it usually sets a very strong fundamental floor for the market, which obviously contrasts heavily with those weak technical charts we just analyzed.
Adding fuel to that bullish narrative, the put-call ratio has spiked to 1.24, up from 1.01 in the previous session. When you see an increasing PCR above 1, it means traders are aggressively selling puts compared to calls. Basically, they're betting the market won't fall, effectively firming up a bullish market sentiment among derivative traders.
But, and this is a huge but, here is your massive red flag. While institutions buy and option writers sell puts, the fear gauge, the India VIX, surged nearly 4.5% to 19.63. The VIX is sustaining above all key moving averages. This signals severe underlying concern. The market is pricing in large expected moves, and as you know, elevated volatility is historically a major risk for the bulls.
Now, if we peek under the hood at the market internals, the picture aligns way more with that VIX spike than the institutional buying. We're seeing aggressive bearish positioning. 74 stocks saw an increase in open interest alongside a fall in price. That's your classic short buildup. Another 77 stocks saw long unwinding. Compare that to only 34 stocks showing long buildups. The broader market is very clearly leaning short right now. Oh, and a quick administrative note for you derivative traders out there, make sure to keep Kaynes Technology and Sale off your list today, as both of those remain under the F&O ban limit.
So, we're looking at a battlefield perfectly split right down the middle. Institutional cash is pouring in, put writers are feeling confident, yet technical moving averages are broken, internals show heavy shorting, and the fear gauge is flashing bright red warning signs. So who actually takes control at the opening bell? Ultimately, the answer lies in strict risk management.
Section 5. Final Trading Blueprint, Your Tactical Edge. Let's distill all this conflicting data into a concrete, actionable plan.
All right, here is your game plan based entirely on the data. Number 1, operate strictly within the 23,250 to 23,800 range. Frankly, this is chop zone territory until a clear breakout occurs. Number 2, do not blindly buy into the 24,000 options wall. The data shows immense, heavy resistance right there. And number 3, prepare for turbulence of volatility spikes. You have to let the levels dictate your action today, not the noise.
I'm going to wrap up today's briefing with a stark reminder straight from the data analysis. Keep your eyes glued to that fear gauge. Sustaining below 18 can definitely support the bulls, but if the India VIX crosses that critical 20 mark, the entire battlefield changes and downside risk accelerates dramatically. So, the big question is, will massive institutional cash shatter the technical resistance, or is this surging fear gauge setting up the ultimate bull trap? We'll find out right at the opening bell.